Hello everyone, my name is Kamal Manocha. I represent PMS AIF World. Welcome everyone for this Friday webinar. Taking the rhythm ahead, as always promised to bring the most pertinent webinars. Today the topic is, very interesting. We want to understand from Anand Shah, who heads alternatives in ICICI AMC, what is the way forward. There has been an event which got unfolded this week, and there have been certain surprise, and at the same time it brings a lot of opportunities. We want to understand, what are the challenges, what are the opportunities, what are the projections for year ahead or times ahead for equity markets. Anand, has a very credible experience in the field of equities. We have seen him giving great returns across all ICICI products, and that is where he was the best choice to do this discussion with him. We know that the mandate that government has got, looks to be very interesting. It has, a lot of optimistic side as well as a challenging side. But how does that reflect in choice of sectors, choice of businesses? There have been, words going on in the news that maybe now the erstwhile bull run may end, and the sectors that kind of led the last bull run, some of the ones like manufacturing, industrials, infrastructure may take some kind of a backseat, and the consumers, the IT companies, private banks may take the front seat. But we would want to understand from Anand what is his take on the entire cyclical type of market that we are seeing and the way forward. Welcome, Anand, to this webinar. You can see, we already have more than 350 people that have joined us for this webinar. So what kind of I would say people and audience who are waiting to hear from you. We'll kind of take it ahead from here onwards. I have a set of questions that I would definitely want you to answer, but broadly, I want you to first cover your comments on whatever I have said. How do you feel? What is your level of confidence on equities going ahead with whatever the current event unfolding that has happened?
Thank you, Kamal, and it's always a pleasure to be at PMS AIF World. Thank you for having me, and I'm sure you have a large audience, and it's so fabulous to be there with them today. First and foremost, Kamal, before I talk about a very short term, I want to talk about very long term also. And as I share with the audience and you, my experience of 23 years that I've been in this market, trust me, there are two things which are constant. One thing we all know, which is wealth creation. Look, this market over a 23 years of period have created wealth, and today that's not a surprise. Investors are convinced equity is a good vehicle. There was times when we had to convince people to invest in equity. That's not the case today. But I think the other constant of the equity market, which people tend to forget, is volatility. And it's not only related to elections. I think in last 23 years, we have various reasons, starting from dot-com crash to global financial crisis, to European debt crisis, to more recently COVID and Russia-Ukraine conflict, really leading to inflation and higher US interest rates. So I think we have seen many challenges, many a crisis, global and the domestic crisis. We have also seen an election upset in 2004, leading to markets falling 20% on a given day. So we have seen all that. And when you look at that chart, it's a telling chart. It's a telling chart that amidst all the crises, the markets have been resilient. No doubt they have corrected almost in last 23 years, maybe 10 times, depending on which indices we are looking at, which index we are looking at. It's corrected more than 20%. So it's not that markets don't tend to correct in excess of 20%. That's a norm. That volatility is given. When I see those times, those crises, those challenging periods, and then compare it to today, I think this is not as difficult a time. So giving you a very long answer to a short question, that does things change for us? Do we believe these election results changing things drastically for economy, for markets, for our portfolios? The yes and no answer is no. I don't think that's a significant change. In terms of coalition, I think it's only last 10 years have been exception. Prior to that, we have survived and thrived under the coalition governments. I don't think that's new. Compared to those times, the current mandate is still very strong. So stability, I think, doesn't change as much. More importantly, the direction of the policy reforms, direction of the economy, focus on manufacturing. I think nothing of that really changes as we read today. We are also observing all these events in front of us as they unfold. So it will take some time to get the clearer picture. But if you ask me today, as we read, nothing changes for the portfolio and for the economy as we speak.
Sure. So, given your background and experience, if you were to put, yourself in investor's shoes, how I would say confident are you? You have given I would say conceptual reply that yes, equities are volatile, equities are in long-term bullish. But in an unbiased way, if you have to answer, we know that markets were going through tough phases even in the past 5 years or past 10 years. That's the nature of equity markets, and so will happen in future. But at the current juncture, whatever information we know of the event, that's kind of the way it has unfolded. What's your level of confidence? You see that optimistically, pessimistically, or you kind of feel that it has no bearing?
I think we were fairly optimistic on the overall economy. I think compared to the 2014 and 2019, the starting point of the previous two terms, the economy today is much more stronger. Your GDP growth rate starting point is stronger. Your fiscal deficit is very strong. Your forex reserves are strong. So from various macroeconomic points that you look at, I think we are on a stronger wicket today than what we were in 2014 and 2019. So that's the first and foremost point as far as the outlook on the economy is concerned. The second point is earnings growth rate. I think last 3-4 years, markets have rallied against everybody's expectation, right? I have not met anybody who has been not surprised at the pace at which the equity markets have done well post-COVID. And nobody expected that to do that in that strong a manner. The point being that what is surprising has been the earnings growth rate also. So I think we have seen also one of the fastest earnings growth rates. So the key question to ask is, how do you see the economy in next 5 years? How do you see the earnings in the next 5 years? And in both contexts, I would say that we remain fairly confident before the election verdict. We remain confident even after the election verdict in terms of the way economy is going to do. We fairly remain confident of the growth rates for our economy in excess of 7%, given the global backdrop. And I'll come to global backdrop in a while. And so much so on the earnings growth rate, again, led by manufacturing allied, and banking. These are the three areas that we remain fairly overweight. We remain earnings growth rate also will be strong across the market caps, and that's where we remain positive on the equity markets from a 5-year plus perspective. If that was your question, that is what I would say.
Sure. So, given the economic growth, the way it has been going over last 5, 7, 10 years, and the kind of euphoria there is with regards to India moving ahead, Indian economy moving ahead from, we have seen from 3 trillion to 4 trillion to 4.5 trillion, and now obviously crossing 5 trillion. So we are very bullish. We understand that, and also you are saying that the future growth will be led by some of the I would say same sectors which have actually led to the kind of growth that we have seen in the recent past, like manufacturing led growth is what you are anticipating. However, from the point of view of kind of managing the portfolio and the fund management view, do you see that some of these sectors which have led the last bull run have actually run ahead of the expected earnings, and hence in terms of valuations, they may kind of struggle, and maybe hence the cyclical nature of market may give them some kind of a time correction or a pause, and then there will be a change of sectors and the kind of new sectors will emerge.
So as I was saying that the direction of economy is something which we remain confident of. Let me take you back and saying what was the starting point? The starting point when we started off in 2014, we just coming out of taper tantrums. We had an export shock due to the commodity price correction. You had a demonetization. You had a GST implementation. All that leading to again we had a RERA implementation. Real estate price correction in 2018, 2019, leading to NBFC crisis and bit of a real estate housing finance businesses that were under stress. So again, I'm repeating, and then when we tried to stimulate the economy to some extent, again through capex mode, we cut the interest corporate tax rate in September 2019. More importantly, for the new capex, we cut the income tax rate down to 15%. We tried again to stimulate or I would say encourage private sector to do capex. What happened subsequently is again the history that then we again lost 2 years due to COVID. So if you ask me, the economic recovery is very nascent today as we speak. When you speak that some of these businesses have run ahead of the earnings, to me personally, the order books have just started to grow, and as you execute these orders, the earnings will down to follow. I think the key variable to watch in times to come would be what's happening to the private sector capex. I think that's the key today. Indian private sector, X of banks, as per our analysis, generates almost in excess of 11 lakh crores of cash. And they're today deploying back only 6-7 lakh crores of that. They're not leveraging. On the contrary, they're deleveraging. Like this cycle were to change, if the private sector gets confidence, not only in the domestic consumption, which I'll come to, the growth in the domestic economy, but also opportunities in the exports, as China leaves some space for the rest of the world to do some manufacturing. I think we will see a round of private sector capex, which will follow up to the government capex, which we have seen for the last 5 to 7 years. Government capex will also continue, no doubt about it, but I think private sector capex is something which can kickstart the virtuous cycle. Coming to domestic economic growth rate, I think the key there will remain the housing. I think the strength of the housing market has been the backdrop of the economic recovery. If you see the last 3-4 years, many things fell in place together. You had a fall in the real estate prices post-RERA and the NBFC crisis. That was one. The second, interest rates are also fallen. So the both things happening together led to some bit of takeoff and cleaning up of the unsold inventory for builders. And subsequently, if you see even numbers today, I think that numbers continue to remain strong volume-wise. And surprisingly, and good news is that the pricing is, barring some pockets, remains benign. So the pricing is not moving up, but the volumes are moving up. Another good news for the housing market. So housing is a big driver of manufacturing. So every square feet lead to more needs for white goods, needs for wardrobes and clothes, and so furniture and the tiles and all that. So very clearly, housing is one big. The other one is manufacturing, which in turn can create lots of jobs also in the blue collar. So both these legs we are looking very closely, and if that remains, then the earnings growth rate we believe is not come to an end, but it's just begun. So a long answer to your question, but the point is that while market is just warmed up post, I think the last time we saw positivity in this segment of the market was in 2007. The rally ended by 2010, and since 2010 to 2020 was a long bear market for cap goods, for industrial products, for manufacturing in general, textiles, metals. All that is coming out of a very long bear market and just started to recover. Yeah,
Sure.
Kamal.
Sure, sure. So, what are the new sectors that you see now? We will see a fresh budget come up with this, government that we have seen. But given the current, I would say, juncture of the kind of policy makers that we are going to see ahead of us, and at the same time the valuations of various sectors, what are the new upcoming sectors which you think from here onwards will be also participating if they may not have been participating in the past?
So on the onset, let me tell you, we give too much credit to the government in creating this sector. I think there are cycles, and there is demographics which creates this opportunities in sector. As I said, manufacturing is partly because of the efforts by this government, but partly also because of demographics of China. As China becomes prosperous, as China ages and its labor cost goes up, the need for cleaner air, cleaner water goes up because of prosperity. There is naturally manufacturing shifting out of China. Till yesterday, it was moving to Vietnam, to Bangladesh, to Cambodia, to Southeast Asia. Now India is also prepared to capture some bit of that. So I think part of that is cycle, part of that is to do with external factors also. Nevertheless, you asked me, where do we see new opportunities, where do we see newer segments of the market? I think within the consumption basket. So the Indian middle class is slowly becoming upper middle class and rich also, some of that. And that has implications in terms of segments of the market. So a large part of consumer-led rally in the previous 2 decades was goods. It was FMCG, paints, it was tiles, it was white goods. So we consume a lot of goods. But as it happens in any economy, as it happens in any country, as the per capita income moves, the incremental spend happens in services. So while you still consume consumer goods, but incrementally a larger part of your money is spent in the consumer services, which involves education, which involves travel, which involves restaurants, which involves wealth management services. So I think where we are focused on, or rather within the consumer space, we are more overweight on consumer services. Even the goods that you are consuming or purchasing, that's changing from unorganized to organized. So organized retailing is one area, the restaurants, the food delivery, hospitals, hotels, airlines. These are the areas, foreign travel, education. These are the areas where incrementally the upper middle class would be spending. And that's where we are finding opportunities to invest in. Apart from manufacturing allied, and the banks, I think these are the 3 core part of our portfolio, which remains, but incrementally within the consumption, the services itself.
Sure, sure. So I understand that you are a bottoms-up fund manager and you will be more opportunistically looking businesses, and you partially give credit to whatever government has done with regards to the possible returns that you would have created in your portfolios. I absolutely fully, appreciate and understand that aspect, and hence going forward, your returns will be more dependent on the growth in these businesses and how, I would say, insightfully you are able to identify some of these bottoms-up, businesses. And taking this discussion ahead, on the similar on this context, I wanted to kind of highlight, maybe in simple terms, if we say manufacturing was one big area in your portfolio which has given you a lot of bottoms up earnings growth oriented stories till now, right? What are the other 2, 3, 4 sectors, if you have to give me names, that you think from here onwards you would want to add in your portfolio?
No, so look, before I come down to what are the other sectors we are looking at, it's very important to understand that, look, macro will create opportunities and challenges both. So it's not that we are not looking at macro, we are not looking at what government is doing, what are the policy. To me, macros are important for idea generation and idea validation both. So we continuously analyze macroeconomic conditions. We continuously analyze what's happening in US, China, in India, what are the various government policies, and then it brings us to a certain universe of stocks which we believe will positively get impacted and the ones which will get negatively impacted. Once we do that, then the work starts. It's the starting point. That's when we do the bottom up research. The research team, the funds management team gets involved in identifying then businesses within the sectors. So when I'm saying that we give too much credit to the government, yes, they on the margin can help a certain sector which is bound to do well. And that's what I was saying, that manufacturing as it is was benefiting because of China. Now it will further benefit because the government of the day is also wanting to support and encourage growth in the manufacturing. And that's how both the top down and the bottom up meets. Then we go ahead and identify sectors. Today we don't have everything in manufacturing, but we do have a lot in metals or textiles or auto ancillaries or some bit in chemicals. We scan the entire manufacturing sector and then we pick where is the risk reward favorable, the valuations are favorable, the growth expectation is much higher. Coming to a question of beyond manufacturing, in the first place, the manufacturing itself is more than 10-12 sectors. So we're looking at many of these sectors as it is within manufacturing. But one key sector that emerges within the manufacturing allied is power. I think after a very long period of time, we are talking of a sustained situation of a power deficit in the country. And that will lead to accelerated investments in not only power generation, but also in T&D. And that's where the entire power value chain from generation, transmission, distribution, EPC providers, transformer manufacturers, the solution providers, everybody comes into the play. So that's one area where we're continuously looking for opportunities. As we said, banks, but within banks, there are services, wealth management services, asset management businesses. As a Indian household will continuously increase its consumption of the services, and not only the travel services, but also the financial services. That's another area. The entire value chain of financial services, from asset management as a manufacturer to the wealth management, which is an advisor, distributor. We're looking at all that piece also very closely. So beyond banking, the wealth management and the asset management businesses, insurance companies are also these areas which we like positive.
Sure. Anand, so I am asking you same question, little differently. So the answer that you gave, does it change if we had done this webinar 10 days ago? So the basic thing which I want to understand is that over last 1 week, have you done any changes in your portfolio, or have you discussed amongst your team members to bring some changes in the portfolio given the current event?
So I think this is a question I've been asked, and I've been telling people that no, because you have to understand that, look, there were as far as the outcome of the election is concerned, what does it mean? Does it mean the continuity of the policy making? Yes, it means continuity of policy making. Does it still have stability? I think as per our calculations and our internal understanding, I think the stability of government is also not questioned. I think prior to 2014, we had coalitions with much lesser majority also finishing the full term. So I think that's also not disturbed from our perspective. And to that extent, we don't envisage significant or any change into the portfolio as we speak today. And again, I'm repeating that as because these are just 2 days since the outcome, and we are still, as much everybody is hearing in the news channels, we are also observing and gathering information from the same news channels. We don't envisage significant change or any change in our thinking on economy, on earnings growth rate in the immediate term over next 2-3 years? Does EPS for my companies, EPS expectation for the overall index, does it change significantly? The answer is no. And to that extent, no changes on the portfolio that we envisage.
Sure. What are the next set of reforms that you see this government should be executing in this third term? If you have in your team or in your framework factored any such possibilities, and you're expecting that, what are those?
So again, did we have a wish list of a next set of reforms from this government, which was large reforms or a significant reforms? To me, I think we would rather have few years of less disruption and more execution. I think this would have been my wish list, and frankly speaking, we have done a lot last 10 years, and I think we are in a very good place. As I rightly said, that we are at a good starting point. We were not at the good starting point in 2014. We are definitely not in a good starting point in 2019, as we got hit by COVID immediately. And to that extent, I think a few years of stable regime in terms of regulatory regime would actually augur well for private sector capex and will augur well for overall GDP and earnings growth rate. So today, as we speak, we don't have a large wish list of groundbreaking reforms as we speak. I think we want to see more of the same execution. I think some of the achievements like UPI, direct benefit transfer, they're just phenomenal. The FASTag that you've done on the roads, again, not much talked about, but again, brings in so much of productivity, so little leakage. Similarly, in other areas that you have done, where you have been able to deliver services to the common man without much leakage, I think that's a phenomenal achievement. And I think I would like to see more of the same in next 5 years.
Some of the sectors, which actually led the past bull run, I would say, for example, consumer businesses, which we have also been hearing as constantly compounding businesses. They have actually not participated in the bull run which we saw in last 2-3 years, probably because the valuations were too high, and we were in an era in last 2 years where interest rates had gone up substantially, and hence market turned value conscious. Do you see that thing continuing, or you see now at this juncture some of those consumer businesses which are like Nestle, Asian Paints, Titan, Bajaj Finance, HDFC Bank, some of those, they will see the comeback and they will become again darlings of FIIs as probably interest rates come down and FIIs come back? Obviously there are a lot of ifs and buts, but there are these assumptions and understanding that now maybe from here onwards we could see again a growth style coming back. So what are your thoughts in this regards?
So I think growth style is in India always in favor. The challenge is the growth has moved from those sectors to these sectors. It's not that people have given up on growth, but I can actually share, if possible, with you. But the fact of the matter is that in the last 4 years, the earnings growth rate in those darling sectors or the darling companies of the 2010 to 2020 had been much lower than the earnings growth rate in the manufacturing allied, which were not darlings for the right reasons between 2010 and 2020. So I think coming back to your question, I think it's not only about valuation. I think people are missing the point that these are the businesses which benefited as China exported deflation. Look, for almost a decade and a half, things used to come not only for India, for the rest of the world. China was a factory for the world. China would produce anything and everything from safety pin to boilers, from tiles to tiles, anything that you want, including your Ganeshji ka Murti or your toys or your shields, whatever you want to get manufactured, used to come from China and used to come cheap, which meant that if you're a consumer of those goods, and which would be typically these FMCG companies, which would be consumer of those chemicals, their product prices were not competing with Chinese companies. They were benefiting from the lower inflation or the deflation exported by China. And it was hurting the manufacturer of the same stuff. If I'm a manufacturer of steel, if I'm a manufacturer of aluminium, I suffered. But if I'm a consumer of steel, of aluminium, like auto companies, I benefited. That cycle is changing. Now China is no more exporter of deflation, but it's an exporter of inflation. That's why I'm saying there are many external factors also which is helping manufacturing in general, not only in India, but ex-China or within China. The manufacturing is bound to do more. So
You want to refer to any slide?
I'll just show you that. I don't think we have it here, but so there's very clear stronger earnings growth rate in this area is what I was trying to refer. But coming back, so I think that's the reason why, and the second point being that there was also an environment prior to 2020 where smaller set of businesses to do well. As you named few, those were the companies which were doing well, and a large segment of the market is to do badly. And same applied within financials. 2 banks used to do well, rest of the banks had an NPA problem. Now, as we speak today, everybody is doing well. There is a general recovery in economy led by housing, led by manufacturing, which in turn helps the broader, smaller businesses. Mid and small caps are also, rather, mid and small caps are doing better on the earnings front versus large caps. But within large caps or within the broader market, all the sectors are doing well. Then the relative valuations of those businesses still remain much more expensive, even after the 3-4 years of underperformance, relative to what the erstwhile businesses which were doing badly. Today, they still remain cheap. Now, the key question to ask is, how are the next 5 years earnings growth rate? Who will do better? Whose ROEs are improving? Whose ROEs are actually coming down? And if you have those answers, then you know which companies will still do well relative to each other.
And hence, what are those businesses, where ROEs will continue to, show maybe the upward trajectory of growth, or maybe, the ones, please.
Yeah, so I thought it was well understood, but our portfolio still reflects that we have less of those erstwhile growth quality businesses, because we find improving growth earnings here much faster in manufacturing allied, corporate banks, but we also see improvement in ROEs, which in turn, what I'm saying is, you have higher earnings growth rate, you're improving ROE, which means the quality of the earnings are still improving and the valuations still remain reasonable. In one of the previous questions you asked me, they've already run up too high. If you look from price to book, or we look from price to earnings, they still remain relatively cheaper than the broader market. Again, I'm talking about my portfolio. There would be businesses, certain companies which we don't own might be far more expensive, but when we do bottom-up stock picking, we find value. We find relatively reasonable prices on the price to book, price to earning in our set of businesses that we own in manufacturing allied, and the corporate banks relative to the broader market.
Many investors, who have been sitting on the sidelines or have been kind of waiting for election results to unfold and hoping that because markets have run up in last 2 years, probably after elections markets will come down, and today they see markets are at new all-time high. What do you say to those investors? Should they now at this juncture continue to keep holding, or they should jump in? It's a very practical question, very difficult to answer, I know, but if you are in that situation, how would you kind of now at this juncture take that entry into the equity markets, assuming that from the asset allocation perspective there is a there is a gap and investor deserves to have more equity given his profile age, but he has been kind of trying to time it and waiting, because that's a natural phenomenon of any I would say investor given the event.
Yeah, I think we all know the answers. It will have to be a systematic one, because while as I said that the outlook remains positive for us, so we would not want to have a lower equity than what the asset allocation model would want. And to that extent, if you are underinvested in equity, you have no choice, or rather you always have a choice, but you should increase your equity allocation towards your stated, whatever asset allocation. Now, how do you approach it? I think there's no science to that. It's typical STP advice, which otherwise we always give to people, that rather than timing, which in turn creates stress, creates uncertainty, a 6 month or a 3 month, depending on one's comfort, you can always deploy and reach to the equity allocation that is relevant to you.
Are there any risks that you see, which today, because of euphoria, because of market kind of making its new all-time high and positive sentiment, we are kind of forgetting, we are missing? Any risks that you have as a fund manager, as somebody who ought to have better understanding of things beyond one's sentiments and emotions, which investors may today be missing and should know?
I think there are always risks in the equity market. So I started with that, and I said there will be corrections in the market. There are two types of risk: one which are known risks, and or rather I would say anticipated risks, and one which are unknown risks. And again, I'll distinguish between the two and saying the anticipated, the known risks generally don't have significant impact on the markets. The negative reaction on the equity markets because of all the known risks, be it Brexit, be it US rate hike and all that, was minimal. The large impact, large corrections in the market happens invariably because of the unknown risks, which are unknown today. So I think that's why we do asset allocation. That's why we always have some bit in equity, some bit in fixed income, so that if there were to be that unknown risk were to play out and you have a significant correction, you can always up the equity allocation. So given the valuations and the area and the relative valuations in the past, we look at we are not in the rich zone, we are not in the cheap zone, we are somewhere in between. Your asset allocation, the equity allocation within asset allocation has to be moderate, and any such risks as and when they play out would be opportunity to increase the equity allocation. But it's a given that equity market is fraught with risk. There will be corrections, and there will be corrections when we least expect it, unfortunately. So that's a fact.
Last 5 years, despite I would say elections in 2019, COVID in 2020, we have seen markets have given equity markets across some of the good products. If I talk about, the returns have been upwards of 20-25%. Do you project the similar kind of expected returns in next 5 years, higher or lower? What are your views?
So again, we've done an interesting work. We did returns over 2 10-year periods. 2004 to 2014, the UPA time when Dr. Manmohan Singh was the Prime Minister, market is approximately up 400%. And we took the next 10 years of NDA2, which is 2014 to 2024. Actually, the market is underperformed. So it's still up 3.5 times, but nevertheless, the money made over a 10-year period is an outcome of earnings growth rate. It's an outcome of a starting valuations. I think these are the two elements. What has been the starting valuation and what has been the earnings growth in the subsequent 10 years. I think earnings growth rate, while should not disappoint us. We remain fairly confident of the economic growth rate and the earnings growth rate over the next 5-10 years period. What happens to PE multiple is something which is anybody's guess. As I said, it's not in the range where I would say avoid equity. So if it had been super expensive, I would say even if earnings growth were to be there, if the PE multiples fall, you will not end up making reasonable money. I would have said don't bother. But today, as per our valuation model, we are somewhere in between. Even if there were to be some PED rating, and if the earnings growth rate remains strong, you will still have a reasonable returns. Not as good as last 5 years. Last 5 years have been too good. I don't think that is something which, because you're looking at the base of COVID, from there the returns looks very good. Those are not possible, but nevertheless, relative to the other asset classes, equity tends to deliver superior returns given the volatility that is involved. I think that is something which is still doable given the valuations are somewhere in between.
Yeah, sure. I was not looking from a base of COVID, because then it would have been 4 years. I was talking about 5 years, which is like from 2019 onwards. But absolutely, you mentioned a very pertinent point that yes, from 4 to 14 and 14 to 24, definitely in the last 10 years, equity markets have in fact relatively underperformed. And then that kind of gives a totally different perspective to how current valuations one should look at. We have discussed about valuations as moderate, earnings growth, which is expected to remain buoyant. But at the same time, liquidity is third factor, which determines the future growth of equities. If valuations and earnings growth are two factors, third factor is liquidity. What are the views on liquidity as a third factor from here onwards? FI money, FDI money, interest rates, because that will also impact the future projections of how equity markets will give returns in the next 4 or 5 years.
Excellent question. I think this is a very relevant point, and that's where it's very difficult one. But just before I come to that, Kamal, go back to the previous question. I think you also have to understand that markets deliver very subdued returns in the 5 years prior to that also. So when you're looking at a 2019 base, the 2014 to 2019 was not that exciting, given we had an asset quality review, we had DMON, we had GST, we had RERA, we had NBFC crisis. So I think to that context, when you see 10-year returns, they're reasonable. And to that extent, again, that's why I'm saying we are not usuriously priced even after such a sharp rally. Coming back to liquidity, I think the big counter factor to the domestic liquidity has been FIs, right? So we have had last 2 to 3 years when, despite of strong economic outlook, strong equity markets, we have seen net FI selling because the US interest rates are going up. So I think that while the domestic liquidity will remain strong, I think SIP as a culture is here to stay, and if at all can only get stronger from here is what our belief is. But notwithstanding that, I think the swing factor can come from FIs, and that swing factor is subject to what's happening to the US interest rates, what's happening to commodity pricing in general, inflation expectation in US, and to that extent, that's something which in 2 years' time, if not 1 year's time, people were initially expecting that we'll have some rate cuts in calendar year 2024 itself, but that can be one tailwind to the equity markets in 2025 if the US is able to manage soft landing and inflation to remain soft for a few months, which allows Fed to take the decision of start cutting interest rates.
Sure. We have seen in the current market 2 different types of fund managers. On one side, there are fund managers like very buoyant, very bullish, and they're still bullish. Like, you are absolutely sounding that yes, equity in long term does well. There are risks. Market tends to be volatile. Equity in asset class is inherently, supposed to have a characteristic of being risky. But the future is buoyant. Economic reform process will continue, and yes, India is on its growth path, and hence stock market soon, will eventually, give great returns. May not be as good as last 5 years, but they will tend to give decent returns. This is what you are absolutely conveying. But at the same time, I see there are certain other fund managers who on 4th June, when markets were down, were kind of claiming that this is the day one of a bear run. it's like markets have now, because they were waiting for correction to start. Many fund managers, I'm not talking about one fund manager I cannot name, but there are many fund managers who are sitting on sidelines who are still holding 30-40% cash, and probably they are mid and small cap biased, and they are not getting entry into the market. And when they saw the kind of results that were disappointing, and market kind of saw bears taking the grip on fourth, they were a little excited, and they felt that is a day one of a bear run. So now again, things have totally become in the hands of bulls, because probably investors today are seeing a long-term possibility. And I'll add on to what I'm saying. Those fund managers also say that over the last 5 years we have seen more than 10 crore new investors who have come to the equity markets. They are yet to see fall in their life. How will they behave when markets will fall? And yes, that is what is a fact as well, because yes, there have been many new investors who have come to the equity markets, so that risk also remains. So given all these understandings that you have, what makes you not talk about those risks, or how do you react to some of those factors? Because many of these investors today who are sitting at liquidity and are wanting to invest have all these thoughts which keep them confused. They are wanting to be bullish, but these factors, that when they read on social media, when they kind of talk to other advisors, they get such confusing views also, and that kind of distracts their kind of mind, and then ultimately they end up eventually investing at the peak when they lose all the entry points. How do you kind of read and see all these factors?
So let me reshare. So let me reshare my slide. You can see a screen, right? This screen, which is my favorite slide. And for those investors, you can hear me, right? Kamal?
You can hear me, right?
Yeah, I can hear you. You can hear me?
I can hear you, but I can see only the first slide, which is the title slide.
Yeah, so it will come, I think, next slide. It will come. So,
or let me, if it's the same presentation, right, which I was earlier showing.
Yeah, let me stop sharing. Fair enough. So, yeah, so if you see the next slide, yeah, this is the slide which is all, and last 23 years I've been answering the same question, that market kya lagta hai, and it's futile, to be very honest, because market will correct. And again, I'm repeating that I'm not saying there are no risks in the market, but the known risks don't lead to a significant correction. The unknown risks, which are unknown, to be very honest, which will lead to a correction. In the same breath, let me also tell you, in 5 days' time, we would be discussing what will come in the budget. And again, some people will get bullish, some people will get bearish, but nevertheless, depending on their biases, they will discuss budget in either bull way or bear way. And after budget, we'll be again going back to the basics, which is earnings growth rate, economy, and that's when the real game starts. And that's where I go back to my first point, that every one of us, it's not that no one is surprised with this rally since September 2019 or post-COVID, actually since April 2020. We all are surprised. We all surprised with the ferocity of the bull market, how the mid caps and small caps have done well. It's not that we are not surprised by that. But when I look back to the numbers, and when I look at the Nifty earnings growth rate, mid cap earnings growth rate, small cap earnings growth rate, and that's not only EPS, when I look at the aggregate cash flow generation by businesses, which reflects how they have delivered. The corporate India in last 3 years have reduced debt. They have not increased debt, right? They have deleveraged. Banks are struggling whom to lend, because people are generating so much cash flow and returning money to the banks rather than borrowing incrementally. So, obviously, large part of the new incremental lending is happening to the household. Household is leveraging. But the point is that the earnings growth rate and the cash flow generation behind those earnings growth rate is surprisingly strong, and which is a combination of factors beyond India, beyond Indian politics also, which is, as I said, has to do a little bit with China, a little bit of, how, energy crisis in Europe happened, how the electricity growth rate, the consumption as the AI picks up, the electric consumption in the US is picking up, and what are those implications for select companies in this country. So I think we are more bottom up, and that's why we worry less macro. Doesn't mean we don't have macro risks in our mind. We stress test all the macro risks to our companies in the portfolio. What does a crisis, higher interest rates in US mean for Bharti Airtel? Or what does it mean for Tata Steel? So differently, they don't impact them similarly. It impacts one more than other. So we are cognizant of all the risks. We stress test those risks onto the individual companies and then do a bottom-up stock selection. I think that's how we work, and that allows us to remain safe and not get carried away with the headlines that come practically every day. Yeah.
Sure. So I see, even in the small cap strategy like ICICI Pipe, you are kind of not holding any cash. So this is where I want to understand that obviously things are going in your favor. Absolutely, that is how we chose you as a fund manager to do this exercise in terms of projecting equities way forward from here onwards. But at the same time, what are those signals that will ever kind of give you some kind of direction to maybe hold some cash? Because I have not seen ICICI's portfolios kind of adding up cash. There have been various times, even in 2022, when interest rates started to go up, there were certain other fund managers who started adding cash. But you have been kind of purely focusing on businesses and doing bottoms up kind of portfolio construction. Even today, you are doing the same. Things are absolutely going in your favor. But taking the cue from the last question, what I was trying to say, that there are certain fund managers who take cash calls and who today have taken cash calls, especially in their small cap portfolios. But you have not taken cash call even in the ICICI Pipe kind of a small cap portfolio. Why is that so?
So again, philosophically, we would be rarely taking a cash call, in the sense that when we actually don't have any business. So it's again, if you go back into the history, late 2017, early 2018, we actually, our first pipe series, when we didn't find any opportunities to invest in the equity markets, we took a big call of closing the fund and returning all the money. And we would not shy away when we don't find investment opportunity in the market of returning money to the investors. That's not the point. I think you have to also appreciate that investors or the advisors to the investors would also be doing asset allocation. So on top of it, if I were to randomly take the cash call, that will disturb the asset allocation of the investors. So we very transparently talk to our investors and their advisors who at times are meeting us, that we would otherwise normally don't take cash calls. Unless we don't find any investment opportunity, we'll sit on some cash for a while. It's not that we don't sit on cash. We have sat on cash for a while at times when we didn't find the stocks that we wanted to buy. For the new investors who come in today in our portfolios, we do sit on the cash, because all the portfolio stocks that we want to buy might not be at the right price at this point of time. So for a month, for a week, for 2 weeks, we might be sitting on some percentage of cash. But today, as we speak, we are able to find opportunities. I think that's the key point. The key point is, when we look at bottom up, I'm not saying our portfolio stocks will not correct. They are part of the market. They will react to the market. But when I look at 3 years, 5 years, 7 years out, we are finding opportunities where we're still comfortable owning them today from a 5-year, 7-year perspective. What we've done very recently is also increased the tenure expectation for the investors. We've increased exit loads so that investor comes to our pipe portfolio with minimum 3 years in mind, if not more. Ideally 5 years, but we have created exit loads so that they come with not less than 3 years in their mind. And in that time frame, we are still finding opportunities, and that's why we are invested. But if we won't find opportunities, we will not invest.
Sure. Another, very credible and very popular strategy that you manage is ICICI Contra. And I have been seeing, many of my team members and many people in the industry have been talking about Contra strategy, since it came 3 years ago, that when market kind of changed its cycle, it your strategy was contrarian when everybody was talking about private banks or IT or pharma, at the peak of last bull run, which was COVID. Because it was a contra strategy, it actually identified some of the beaten down sectors like manufacturing, industrials, real estate, or maybe PSUs, and you have made great returns. So because it is contra, is it seeing and kind of trying to, I would say, foresee recreation of the portfolio in that I'm talking about investment style in a contrarian approach? Though I understand that you are still bullish on manufacturing, industrials, infrastructure, you have mentioned that, but from that investment portfolio standpoint, do you see that yes, there is a need to add a contrarian view to that and maybe now add IT or private banks, or you see that day has not come yet?
No, I get this question very often that isn't the IT and the FMCG has not become contrarian yet, and this is the daily question for me. So look, please understand what is contrarian approach to investing. I think that there are two drivers to the wealth creation, or two drivers to the stock price performance. One is the earnings growth rate, and other is the PE multiple expansion. And similarly, the wealth destruction happens if the earnings degrow or the PE multiple collapses. So what we are looking for in contrarian style of investing is where is that part of the market where people expect that earnings growth would be lower and we believe it will be higher. So there will be surprise, and people are also not to that extent are not giving them valuations also. So you're also beaten them down on valuations because they've been underperforming on the earnings growth. And that's exactly what happened to state-owned banks, to corporate banks, to manufacturing, metals, and others in 2020. That not only you punish them for lower earnings, you also gave them a lower PE multiple. So we keep on looking for opportunities where the earnings performance will be superior to what market expects, superior to what the overall broader market will do, but also what the expectation of the investor community at large is. So you get an upside from a higher earnings growth rate. But as they deliver higher earnings growth rate, you also opportunity of a PE multiple expansion if the ROE of the company also goes up. So we are looking for both ROE expansion as well as earnings growth rate, which means that we have a delta EPS, which is higher than the delta in the Nifty or higher in the index, but also PE multiple expansion as a return on equity of the base business goes up. Coming to your question, I think we still see that the select companies that we have again, I'm not talking about a broader manufacturing or a broader manufacturing, right? Everything is not cheap there. But with the bottom up, whatever we have identified, we still see earnings growth superior. We still see opportunity of ROEs expanding, leading to PE multiple expansion, and that's where we are still. On the contrary, in the segments of the market which we have avoided, we are continuously watching them. We have a very large research team, 27 members strong research team, which tracks all sorts of businesses, all sorts of sectors, performing, non-performing, and to that extent, those industries also we are watching very closely. Very recently in our portfolio, we added one organized retailing company 6 months back, which was not part of the portfolio. It's one of the favorites of people at large, but it underperformed for 3 years. It made sense, and then we added that to the portfolio. So we are completely glued. We have no compulsions to own only this and not only that. I don't think that's the way. We had a lot of IT in the portfolio in 2020. We had pharma in 2020, IT all the way in 2021 also we owned. And slowly, as the valuations become very, very expensive, not justified, is when we got rid of our pharma and IT in that portfolio. So Contra portfolio owned IT and pharma in 2020. It didn't own in 2022, 2023. There's no reason for them not to be part of the portfolio in 25 or 26.
No, sure. I think I really liked conversing with you. Very insightful session, and reminds again, why money should be given to a fund manager, because fund managers' point of view is totally focused on the growth in business earnings and maybe PE expansion. And on the other side, it is the investor's point of view, which is always on the rise in value, rise in price, and that perturbs him. Today we know markets are at all-time high. It looks scary, it looks expensive, but if one sees it from the point of view of a fund manager who is kind of trying to project future years of earnings and is focused on identifying some of those sectors and stocks which could see P expansion, one can actually have a more confident opinion on equity markets, and the more confident approach to handling portfolio is what gives greater returns, and that is what a fund manager brings in. And this entire discussion reminds about the same. About the topic that we had kept today, we are quite optimistic. The uncertainty with regards to elections is now over. We have a same government and the same sort of reforms that I think will be seen in the next leg of 5 years. Probably some of those reforms which happened to a certain extent will see a greater extent now. India is on its path to become a 5 trillion economy. All these are some of the, I would say, some of the predictions which we have had in the past. But we know that today the nominal GDP of India, is required to be just say 9, 10, 11%. And if that is there for next 3, 4, 5 years, we will see India at a 5 trillion economy. And hence, obviously, equity markets are bullish and buoyant. Obviously, there will be risks in between, and that is the characteristic of equity market. But having said that, I think, whatever pessimism which we saw on 4th of June is now behind us. Investors need to see equity markets more with opportunistic and the positive aspect of it, because it's a long-term asset class for wealth creation, and India is on its new future. Obviously, there are variety of fund managers who have variety of approaches, and we at PMS AIF World have created this platform for our clients, for our investors, to bring some of the best strategies. ICICI AMC has a lot of products, and there have been a lot of questions on this chat about which is the right strategy at this point. Is it a pipe, or is it a value, or is it a contra? All these questions we can absolutely very objectively evaluate and answer for each and every client, because it depends upon a lot of factors. It's not only dependent on the strategy, but also on the profile of the investor, the time horizon, the existing portfolio, and a lot of other factors. So we welcome all of you to kind of maybe book appointment with us, and we are kind of absolutely ready to give answers to all your questions. Thank you, Anand, for your time. I think it was a very great connecting with you. Again, we'll connect with you, maybe after 3 months. We have a regular rhythm that we have to follow with ICICI, and thank you so much for joining today. Have a nice weekend. Thank you.
Thank you, Kamal, for having me. Thanks for all the participants who have joined us, and have a nice evening, nice weekend.